Warriors of price action and guardians of fundamentals, welcome to Retail Recon. In our last mission, we cleared the fog around moving averages. You learned how these lines smooth the battlefield and separate the bulls from the bears. You now know that the 22 and 150 period lines are your primary orientation tools on any chart. Today, we move from observation to action. This is a target acquisition mission. We are going to look at the exact setups, the high probability rules of engagement that tell you precisely when to pull the trigger. We'll debrief the EMA Bounce, the Golden Cross, and the Mean Reversion play. By the end of this episode, you won't just be looking at lines on a chart. You'll be hunting for entries with surgical precision. So gear up and let's go to work. Before we dive into the specific setups, you must understand the mean reversion principle that makes these trades work. Imagine a person walking a dog on an elastic leash. The person walking is the moving average. They represent the steady trend direction. The dog is the price action. The dog might sniff a bush to the left or chase a squirrel to the right, getting far away from the owner. But eventually, that elastic leash pulls the dog back towards the person. When setting up a moving average trade, I expect, or better said, I bet that price will eventually return to its moving average. If price gets too far above the line, it's extended. Don't buy there because the leash is about to snap back down. We want to buy when the dog is returning to the owner's side. That's exactly where our first setup, the EMA Bounce, lives. The EMA Bounce is one of my core setups for joining an established trend without chasing the top. And before we continue, please keep in mind this is not investment advice. I'm sharing my personal approach and stories. There's no fluff here, as you already know from watching my Recon Reports episodes where I debrief my real trades. Now back to the EMA Bounce setup. Here's how it works step by step. First, trend identification. Price must be clearly trading above the 150 EMA. That confirms that long trend is bullish. Next, we wait for the pullback. We want price to drop back down to retest the 22 EMA support line. The trigger is critical. We don't just buy the moment it touches the line. We wait for a rejection candle. That we covered back in episode 14 on candlesticks. Look for a long, lower wick showing buyers defended that level or a strong, bullish engulfing candle right on that 22 EMA line. When you see that rejection candle complete, that's your entry signal. You buy the shares as that candle closes. Your stop loss goes just below the moving average zone. That gives you tight risk with massive upside potential as the trend resumes its upward march. Let's move to the next setup. Setup 2, the crossover signal. This is the big picture signal that every institution on Wall Street tracks, the crossover. A golden cross occurs when a fast moving average, like the 50 period, crosses above a slow moving average, like the 200 period. This signals a major shift from bear market to bull market territory. It is a fire for effect signal that gets long-term funds moving aggressively. The death cross is the opposite. The fast line crosses below the slow line. That's your get to the chopper signal. It means the trend has structurally failed and broken down. While I personally use the 22 and 150 EMA on my charts, the concept remains exactly the same. When my 22 EMA crosses above the 150 EMA, I'm looking for aggressive long entries and staying heavily weighted toward bullish setups. When the 22 EMA crosses below the 150 EMA, I'm either in cash or hunting short opportunities. This is your ultimate friendly versus foe identifier. You'll see these crossovers play out in future Recon Reports episodes where I debrief actual trades. Setup 3, the extended trade rule. Now let's talk about the extended trade. How do you know when it's too late to buy? Look at the distance between the current price and the 22 EMA. If that gap is historically large, the dog is stretched to the very end of the leash. Buying here is one of the biggest mistakes retail traders make. They see a massive green candle ripping higher and buy out of FOMO, fear of missing out, only to watch price snap back to the average the very next day. The rule is simple. As a general guideline, if price is more than 2 average true ranges or ATRs away from the 22 EMA, the trade is off limits for new entries. We wait for the dog to return to the owner before we engage. This keeps you out of the worst chase trades and preserves your capital for high probability setups. Your perfect mission is Confluence. A professional trader doesn't use just one tool. They hunt for confluence. Confluence is when multiple pieces of intelligence all tell you the same story at the same time. The perfect mission looks like this. Prices is in a clear long-term uptrend staying above the 150 EMA. Price then pulls back to a horizontal support level, that floor we covered in episode 19 on support and resistance, and that horizontal floor aligns perfectly with the 22 EMA, creating dynamic support. And right at that exact intersection, you see a bullish signal in the form of a strong bullish candle or rejection wick. When the floor level, the moving average, and the candle pattern all say buy at the same price zone, that's high conviction confluence. That's where you reinforce your position and add to winners. As always, remember, we deal in probabilities, not certainties. No matter how strong your conviction is, always protect your capital with proper risk management and have a clear exit plan in place. We've covered getting in. Now, how do you know when to get out? Moving averages are the ultimate trailing stop mechanism. Instead of picking a random price target and hoping you time it perfectly, you stay in the trade as long as price remains above the 22 EMA. If the trend stays strong, that moving average line will carry you to profits far higher than you ever imagined possible. You only retreat and close the position when a candle closes decisively below that 22 EMA. That's your objective signal that momentum has shifted against you. This simple rule lets you capture those massive home run moves while automatically protecting your capital if conditions change suddenly. To recap, moving averages aren't just lines on a chart. They're dynamic battlefronts showing you exactly where to engage. Use the EMA Bounce to enter established trends safely. Use the crossover to stay on the right side of the market's big picture direction. And use the leash rule to avoid chasing extended moves. You now have a complete technical foundation. You can read a candlestick pattern, identify key support and resistance levels, and use moving averages to time your entries and exits with precision. If you found value in this episode, be sure to lock in your support by liking, subscribing, and following our movement. And join us on our next episode where I will do a full debrief on everything dividends. Thanks for standing watch with me today, and until next time, trade smart, risk sharp, and stay on target.